Hey everyone, welcome to another live stream with Prof Sales. And hopefully you're joining me from the previous stream that just started a moment ago. I was actually on, and for whatever reason, it would not allow me to share my screen. So here I am in a different place. So I'm going to give everybody a moment to come in. Thank you guys for joining me on a New Year's Eve. It is New Year's Eve 2021. Or 2020 going into 2021. So we're almost done with this crazy year of 2020, which is pretty exciting. I know a lot of you guys are probably completely ready for 2020 to be over. It's been a very difficult year for lots of reasons. And 2021 is right around the corner. So hopefully it's going to be a little better. Let me make sure this is working okay. Yeah, it looks like it's popping up from before. Yeah, I'm going to give everybody a moment to join in. Let me know if you guys can hear me okay. Sorry about that I had a little technical difficulty there with the live stream. But it looks like everybody's starting to join back in. So that's exciting. Looks like technology is finally working for me. What's going on, Mark? Ellis Family Flips. 2020 is out of here. Yes. Not a moment too soon. I think most of us would agree, right? 2020 has been a rough year. But 2021, it's a new year. I always like a new year because I feel like it gives you a chance to sort of start fresh, take stock of what's worked for you, take stock of what you were doing, and see how it goes and see what maybe you can make changes for the new year. But tonight I'm going to talk about dividends and stocks. Now, I need to make a disclaimer. Standard disclaimer, I am not an expert. I am not a financial guru. I am not a financial planner. I am not a financial professional in any way, shape, or form. You should not take anything that I say as investment advice. This is solely for entertainment purposes only and just to illustrate what I'm doing. And I don't want you to walk away from this and say, yeah, Jason said that was a good idea, so I'm going to go do it. Don't do that. Do your own research, talk to your own professionals, just like with anything else. I'm just here to help you find paths that you might want to go down. You still need to go do it. You still need to put in the time. All right. So having said all that, I think we can move forward. So let's talk about dividends for a moment and investing in general. I don't know the age ranges of the people watching this channel right now and watching this in the replay, but if you're like me, you're in your 40s something, and maybe you are in great financial shape. Maybe you're not in great financial shape. Maybe you have lots of money invested, put away, saved. Maybe you are living paycheck to paycheck. I don't know what your personal situation is, but I know that on average, a lot of American citizens, at least in this country, United States, do not have a lot of money saved up. They do not have a lot of money invested. They do not have a lot of money for retirement. They do not have a lot of assets. And again, not a professional financial person, but I think any professional financial person is going to tell you that is a very disadvantageous situation to find yourself in. And I know everybody's got their own story for why that would happen. And I want to talk about those in some other videos, how you can make some changes. But as some of you know, recently, Karen and I, which is my lovely girlfriend, she and I have been doing a lot of things to really improve our financial position over the last year or two, really. And, it really comes down to this, gang. The only person that's responsible for your financial success is you. So you have to look in the mirror and say, all right, where am I at and where do I want to go? What's my situation? So let's start with that. We find ourselves still with some credit card debt, still with some student loan debt, some auto debt, not mortgage debt, but the other debts that are not so great. And so we decided to take action and start eliminating those debts. And in doing that, what's so interesting and what people forget is when you eliminate a debt that you have, whatever you were paying to that debt, now you can save or invest and put your money to work. we started with the idea, and this is not really a new idea, but we started the idea that every month we have so many dollars coming in, and we're going to put each one of them to work. Like nothing was going to be left to chance. We're not going to get to the end of the month or have a point where we say, you know, well, let's just frivolously, we can do whatever we want with this $100 or this $200. We made the conscious effort to say, we know what expenses we have. We know what variable expenses come up. We know what fixed expenses we have. And then everything else is going to be for investing and or saving. So after having done all that, then it became evident that we had more coming in than we have going out. We paid down some debt and got rid of a lot of it. There's still some left, but most of that will go away in the next year. And we now have enough to where we feel like we can invest some money too and save some money. So I don't know about you guys, show of hands. How many of you guys find investing, whether it be for your retirement or to build wealth or whatever, you find it complicated, difficult, hard to get started, tough to plan for, to know what your goals should be? I mean, if you're like me, then you find all those things are true. So I, being the person I am, have done a lot of research over the last probably 6 months or so, trying to figure out what sort of makes sense for our goals and so on. Karin and I are late 40s-ish, roughly, and we are obviously don't have the same time frame that someone would say if they were like 25 or 30. So we have to be a little more cautious. I started with the premise that, you know, the number one rule when you have money is don't lose money, because losing money now at this point in our lives will be tougher to recover. So any strategy that we came up with was going to be based around that. All right, you want to invest, you want to save, but you also don't want to lose money because it's going to be hard to make up losses because we're older. We're not going to we don't have as many working years in front of us as we did, 5 or 10 or 15 or 20 years ago. So any strategy that I've come up with, for the most part, has taken that into account. I don't want to put a huge percentage of our wealth, our savings, or our investments into, shall we say, riskier investments that, while they may not go to zero, they could lose value over the next 10 or 15 years and be hard to recover that value. So I've got that in the back of my mind, and everybody's got a different risk tolerance level. I don't mind some risk, but I also realize the value of, like I said a moment ago, if you have money, don't lose money. That's the first rule, because it's much harder when you're at zero to go back up than it is if you're, just maybe you didn't earn quite the percentage you thought you should earn. That's different than actually losing money. So that's kind of where we're coming from with it. Any strategy we have has to have that number one goal in mind. We really don't want to lose money if possible. It's not entirely possible to prevent that, but we're doing some things. So when I was looking at investment vehicles for that, I knew that if I put money in the stock market, if we just willy-nilly threw money in an S&P 500 index fund, there's, over the long term, that is a fine strategy. For those of you who don't know what an index fund is, it looks at an index of the market, like the S&P 500, which I believe are the 500 biggest cap stocks by capitalization on that index, and creates a fund based on the percentages those companies occupy. And what that gives you is, it gives you a lot of diversification. So if any one company or even 5 companies have a rough year, it doesn't necessarily kill your return like it would if you just invested in those one company. So I think that particular strategy is great. I think that indexing and buying into an index fund like that is a fine strategy, but right now the stock market is at an all-time high. The S&P 500 is at all-time highs. That doesn't mean they won't go higher. They might. It might, but there's also the potential that there could be a decent sized correction, which is, in layman's terms, just means like the value will go down significantly. sometime in the next year or 2 or 3, which then would be a big blow if we put a lot of money into any of those funds. And it would take a while to gain that back, potentially like years. And like I said, we have a shorter time frame than somebody who's in their 20s or 30s. So again, we're trying to minimize the risk of that. We could have just invested in individual stocks, which has some of the largest growth potential, but you run the risk of, with individual stocks, you run the risk of those stocks doing poorly in the short term, and then you're stuck for a while. It's harder to kind of, again, recoup those losses. There is more risk in a smaller number of stocks, number of equities portfolio like that. Like if you're only investing in, say, the FANG stocks, which is Facebook, Apple, Amazon, Netflix, and Google, FANG, that's fine. And those companies have done great in the last 10, 15, 20 years, but there's no guarantee that they're going to do well in the next 10 years. And if 1 or 2 of them have a poor 1 or 5 or 10 year run, you're likely to see a pretty big drop in your portfolio in that part of it. And it's going to be hard to recover that in our case, once we start moving, further up in our 50s and 60s. So I didn't want to do that. I love those companies, by the way, those 5 companies to invest in for the most part, but putting all of our retirement eggs in that basket just didn't make sense. So it's kind of one of those situations where we really had to be smart about how we invested our money. So that's how this idea about dividends came up. For those of you who don't know what dividends are, let me explain it really quickly. I probably should do a better video on this. A dividend is an amount of money that a company pays you for owning a share of that company. So for instance, let's say that a company pays, just to make the math really simple, a $1 dividend every 3 months. A lot of dividends are paid quarterly. Some are paid twice a year. Some are paid yearly. But let's say that a company pays a dividend every 3 months, a quarterly dividend, and it's going to be $1, let's just say, per share. That means if you have 10 shares of that company every 3 months, you're going to earn basically $10, $1 per share. And that amount of money that you get, you can do one of 2 things with it for the most part. You can reinvest it back into more shares of the company, which is sometimes called a DRIP, a dividend reinvestment program, or you can have that dividend paid out to you, and it becomes income. So that's what a dividend stock is. Not all stocks pay dividends. Some pay very little dividends, some pay larger amounts. There's a lot of complexity around that. I'm not going to go into all that, but there's definitely value to dividend investing. Dividend investing, I've read a couple articles recently. There was a big study that the Hartford Insurance Companies did that showed over the last 7 or 8 decades, dividends drove quite a chunk of the percentage of the return of the overall stock market. It was because of so many of these companies that were paying dividends, because the idea is that if a company is doing well, it can reward its shareholders with a dividend. It's probably a well-run company. It knows that dividend has to come in. It's like a fiscal, it's like a type of fiscal responsibility that the company has to impose on itself, because it knows it's going to have to do that every quarter, every year. And typically that makes the company run a little differently. Now, some people would argue companies should be allowed to reinvest those dividends back in their companies to grow. That's a fine strategy too. And there are companies that don't pay dividends that do really well with that. But dividends has been a time-honored and a long way to improve your returns to some degree, and to promote and to set up a recurring cash flow stream. Wow, that's a lot. So dividends appeals to me because the companies that make up a lot of the dividend portfolios that are out there tend to be very stable companies. There's even a list of dividend companies called the Dividend Aristocrats. Wow. I cannot say that word. Karen's going to laugh at me when she watches this. Those companies have a history of not only paying a dividend, but increasing their dividend amount for decades in some cases. So what that means is when you own those companies and you own them year after year after year, not only are you getting a dividend for every share that you own, you're also getting a dividend that's being increased. Maybe it goes from 50 cents to 55 cents to 60 cents to 70 cents, $1 to 110 to 125, whatever. So those companies not only provide a dividend, but they also increase the dividend year after year after year. And some of these companies have done this for literally over 50 years. So when you take into account like a company that's increased its dividend for, say, 50 years, is it possible that that company will start being run poorly, or that events will happen like the extraordinary events of 2020, which have caused some companies to suspend their dividends? Of course it's possible, but it's not likely, given other companies that are out there which don't pay a dividend and don't have that same financial responsibility to their shareholders. So I think a lot of those companies are safer bets. You also make money in a dividend portfolio when the actual price of the stocks, the equities that you own, and it's not just stocks you can have a dividend portfolio, you can have other things too, but when those prices go up as well. So there's two ways really that you're earning from a dividend portfolio. The underlying prices of the stocks that are in your portfolio go up, and the companies pay a dividend, which is income that a lot of times you can reinvest right back into buying more stock. So it's kind of like a little extra boost there. So when I was looking for something to start investing in our retirement and so on, and to start building another stream of income, dividends made a lot of sense to me for all the reasons I've mentioned. They were safer than pure growth stocks. They were not going to get quite the rate of return, but again, they're less likely to have down years. And when they have down years, they're not as severe usually as purely growth plays, like, an Amazon or something like that. That just tends to be the way that those companies are ran and set up. So I knew that was something I wanted to explore. A couple quick questions and comments from the chat. Clearance Ninja says, you're losing 3% on your money in the bank due to inflation. Savers have been punished since 2008. Yeah, I mean, you're right about that, Ninja. People forget that. Like if you put $100 in the bank, every year inflation eats away at that. So next year it might be worth $97. And the year after that it might be worth $95, $75, for sure. So I think that's a good point. And if you're not willing to invest your money, you are likely to lose value due to inflation over time. So just letting it sit there is a strategy, but it may not be an ideal strategy. Mark says invest in a good index fund. And I think and like I said, that's fine. I think you can definitely invest in an index fund and still earn a good rate of return. I think there's nothing wrong with that. I think that index funds have proven to be, for the hands-off, don't care too much about what's going on in my portfolio, I got other things to do to earn revenue and earn income. Index portfolios are kind of a great way to set it and forget it. You can set up recurring investments into those index funds, and every year, every month, whatever your time frame is, you just have that money going in there, and index funds are going to return a decent rate of return, anywhere from like 7 to probably 9% historically is what they've returned. And that's likely to continue. We don't know. I just knew that because of this particular situation where the market is so high right now, and I was starting another portfolio, I really didn't want to do just an index fund. I was afraid that I was really buying at the top. I could be wrong. Maybe the market will take off this year and go even higher. I don't know. I don't think anyone knows for sure. But there are some signs that it may not. So those were some of the reasons why I didn't go with just an index fund. Ninja also asked about what dividend rate are you realistically expecting? Yeah, I'm gonna cover that in a minute. Actually, so there's some technical stuff around dividends, like how much they pay and so on. And dividends pay different rates based on the company. The company can set the percentage of their price that they pay you in a dividend. And you would think you would just go after the companies that just pay a high dividend. Like, I want the ones that pay the highest rate, right? But it doesn't quite work that easily, because some of these companies that pay a high rate, a high dividend yield, they call it, they do not necessarily have the best growth. They have risk around the dividend, whether it will continue or not. So it's not as simple as just you look for the best rates. Unfortunately, that would be great if it were. You would just be like, give me the ones that pay me, 10% of their share price every year or every quarter. But it just doesn't work that way sometimes. So you have to kind of find a blend with what will happen, which I'll cover that in a little bit. But making sure I've got my portfolio up here. So that's kind of where I'm at and why we decided to go the dividend route. Again, I don't know if they're for you or not. That's totally up to you guys, but definitely something to check out. You give up some growth for a little bit more security, probably in the long term. Now, granted, there's ways around that. Ellis asks, what are you doing work-wise? I'm still at Amazon. Karn still has her job, so we still have that. And so we have income coming in. I have a 401k with Amazon that I've been investing in, separate from this dividend portfolio, and that's done pretty well. And I'm probably going to up that investment amount this year. That would be a whole nother video, but 401ks are usually a pretty good deal, especially when you have the employer match. So we've been doing that as well. But the dividend portfolio that I've chosen is to use, or the broker that I've decided to use is M1 Finance. And M1 Finance is a broker that allows you to invest in dividends and so on. They have very minimal fees and so on. They allow you to set up what they call pies. And a pie is just like a section of dividends or companies. It doesn't have to be just dividends. It can be anything. You can do funds. You can do index funds. You can do individual stocks. I believe you can do bond funds as well. You can do a mixture of things. But the cool thing about them is they allow you to really set this up in a way that allows you to kind of structure it the way you want. So that way you get to really, it's almost like a directed index fund, because an index fund, as I was mentioning earlier, has the advantage of it takes all the stocks that are represented in a specific index and builds a portfolio of them based on their weight in the index. This allows you to create like your own little index if you want, and you can make it really, really large with a lot of different stocks. You can base it by sector. You can say, I think oil stocks are going to do great this year. I think that the airlines are going to come back this year. So I want to create a part of my portfolio with airline stocks. Really, there's no limit. And of course, you can create a dividend portfolio as well. So and by the way, there's a link down below in the description of this video, or there will be, that says what dividends, or a link to M1 Finance. It's an affiliate link, and I think they pay like $10 for every person who donates or who deposits money that goes through the link. And you can do the same thing. Like, you can supply the link to a friend or whatever. So if you're interested in that, be sure to check that out. But I'm going to kind of show you what I did, and let's see if I can get my portfolio to set up here. So I'm kind of a little torn, because your portfolio can be in a non-retirement type account, or you can have a retirement type account, what most people know as an IRA. And there's different types of IRAs. I'm not going to go into all those, but I have a separate account that I just started that I'm going to fund probably going forward. But this first one is not set up in an IRA account. It's not in a tax advantage account. And the disadvantage to that is I could have some tax liability. Dividends are not taxed the same way stocks are that you buy and sell over time. Dividends are taxed as, for the most part, as regular income, which means if you earn $500 in dividend income this year, then you theoretically would have $500 of tax liability based on whatever your tax brackets are and so on. Or actually, I think it's a set rate, but don't quote me on that. There are some ways around that, depending on what your income is. You might not have to pay taxes on it, but I don't really feel like I'm knowledgeable enough to go into all that. So I'm going to show you, if I can get this to come up here. Let's see if I can get this to show. So this is my I call it 2020 because that's when I started, my 2020 portfolio. And I started this back on December 23rd, so a little over a week ago. You can see right here. I funded it with $2,000 was my initial funding. And I kind of screwed up a little bit. So I'm going to tell you guys not to do exactly what I did. I really hadn't fully fleshed out all the companies that I wanted in this portfolio. I wanted enough companies that I had some diversity and I didn't depend too much on any one company's fortunes. But I also didn't want to put so many companies in it that I really couldn't keep track of it. And my idea is this, and this is where M1 Finance really is beneficial. My idea was I was going to put an equal weight to every company, which means basically I was going to tell M1 Finance to invest the same amount in every company. You can buy fractional shares with this particular broker, which is cool. You don't have to have, you don't have to buy in one share increments necessarily. So I was going to say, all right, take this $2,000 and divide it between all these companies equally, and then keep them equal over time. So what the portfolio can do, you can tell it to rebalance, which is a number right here. You can say if I've got 10 stocks and they're all going to be 10% in my portfolio, but one stock goes way up and now is 12%, let's say, you can rebalance and you can tell M1 Finance rebalance, and it will sell basically 2% of that holding, your 2% you have, to get it back down to 10, and it will buy something else in your portfolio. And the cool thing about that is if you think about it, it really makes a lot of sense. Like, let's say you've got a stock over, like, let's say you've got Amazon over here, and Amazon has gone up a lot, and now it's gone from 10% to 12% of your portfolio. But let's say over here, you've got Southwest Airlines, which has gone from 10% to 8% of your portfolio. Well, the reason why it went to more is because the price of Amazon went up and the price of Southwest Airlines went down. So when you sell Amazon, that 2%, you're selling by profits that you made in that stock. And when you're buying Southwest Airlines, you're buying Southwest at a cheaper price, which means you're getting it at a discount, which is kind of what you would do with normal investing. Like you would, you're going to have something run up, and then eventually you're going to sell it. Either you're going to keep the money, or in this case, we're going to reinvest it into other equities that are in the portfolio, which is what this one is set up to do. Or you could just leave it alone and you could actually just change your investments in the next month or quarter or whenever you're going to put more money in. But it will allow you up here to auto invest. And if you see, it says, if you turn on this auto invest feature, it says that basically, I'm going to actually turn that off, but it says that trading will be initiated once you have at least $25. And it will go in and it will try to make your portfolio the percentage you set. So when you create this portfolio, whatever it is, how many ever stocks or funds or whatever you got in it, which I'm going to drill down and show you here, you basically go in and let's see if I can get this to show right. You basically go in with all these stocks and you set a percentage over here that you want in them. So I just happen to do this equally with this is actually 20 stocks, but 20 stocks, an equal distribution of all of them is 5%, right? 100 divided by 20. You could put this any percentage you want. You could say, I really want to be heavier in Apple because Apple is a great company. Apple does not pay a huge dividend. It does pay a dividend, but it's been a great growth stock for many years now. and you could say, I want to put less in, Iron Mountain, whatever you want to do. And so you can set these percentages up to whatever you want. And then it will take the initial deposits you start with, and it will divvy it out between all those companies equally. So that's what's really cool about M1 Finance. It allows you to structure a portfolio the way you want. This could have just as easily been in funds. I could have gone, and I think someone was talking about index funds and so on a moment ago. I could have gone in and said, give me this fund or give me a percentage of this fund. Whatever you really want. It's really, really flexible. And I like that. Like, I like the ability to be able to go in and look at this, say, 3 months from now, 6 months from now, and say, hey, this portfolio is getting really heavily weighted with this one stock because it's run up a lot. I probably need to have it rebalance this. Now, there are some downsides to that. You could trigger some taxes potentially, but that's no different than if you'd sold in any other investment. If you put this all in a retirement account like a Roth IRA or traditional IRA, which are options on M1 Finance, then you will not incur. My understanding is you will not incur any of those taxes as long as you trade within that particular IRA account. And that's what I'm going to do for 2021. I'm going to gradually probably push this money over into an IRA, a Roth, and just basically be able to trade within the portfolio without triggering a tax bill. Granted, it wouldn't be a very large tax bill at this point. Like, even, if you're selling $103 of AbbVie, and you're selling $3 of it to rebalance your portfolio, that's not going to be much of a tax bill. But over time, enough of those transactions could add up, and it could be a little bit of a substantial amount if you're not careful. So that's what I'm going to do. But this particular portfolio is set up with 20 stocks right now, and it shows you your pie you have of all of them, and it shows you if they're underweight or on weight. So like Kimberly-Clark Corporation is at 4.9%. The goal is to be at 5%. It's slightly underweight. Genuine Parts Company, which you probably, GPC is the parent company of Napa. If you're familiar with them, it's been around a long time. They're at 5%. So they're perfectly weighted. Bank of America, so on. I don't think I have too many that are overweight. Johnson & Johnson slightly overweight at 5.1%, and so on. And again, you can go in and change any of these. So say like AbbVie is doing really poorly, or something's happened with like their CEO gets put in prison, or they came out with a product and somebody died, whatever's going on with it. You can go in and change the actual percentage that you want. You can go in and basically change the amount you want, like on that screen I showed you a moment ago, where you go into edit and you would say, all right, AbbVie, I want to make it now only 3% of my portfolio. Now that means that 2% has to go somewhere else. Like, you're going to have to add that 2% in somewhere else. But you can customize it to whatever you want. It's like your own little customizable mutual fund with whatever types of companies or stocks you want to have in here. And again, you can, as long as you're in a retirement account, you can make all these transactions in it and usually avoid taxes. But as always, talk to your financial professionals and so on. Sam says, how are you doing, Prof? Long time no see. PayPal added Bitcoin. Yeah, I know. Is the Roth more a guaranteed investment? A Roth is not an investment. A Roth is a type of a retirement account, and that allows you certain tax advantages. And Clarence Ninja saying that too. Basically, you have two different types of IRA accounts, which are individual retirement accounts. You have a Roth and a traditional. The biggest difference is the traditional, you're able to deduct that amount from your taxable income when you put the money in. But when the money comes out to you, once you retire, like you can start taking distributions at 59 and a half in age, you will owe taxes on those investments. A Roth is kind of the other way around. A Roth doesn't allow you to deduct the contributions right now from your taxes. But when you start getting distributions, you won't have any tax liability at all. It'll just you'll get 100% of it. So 2 different approaches, and there's different arguments about which one you should use based on your situation. I'm not even remotely qualified to tell you which one you should use. So, but if you do the research on that and say Roth versus traditional IRA, it'll tell you. But it's not actually an investment itself. It's the type of account that your investments are held in. So I hope that made sense. Yeah, and 401k is a little different too. 401k is usually provided to you by your employer, not an IRA. You can set that up. You can set that up yourself as long as you have earned income, I believe is about the only qualification. But yeah, so this is my particular portfolio, and I'm going to kind of go through a couple of these. I'm not going to go super in depth on these because it's not terribly important at the moment, but they allow you to see your value here, the name of the securities, how many shares you have. You can see I just started this portfolio, your cost basis, which is basically how much you paid for each share on average. This maintenance requirement, this is as if you're borrowing money. M1 does allow you to borrow money. I'll talk a little bit more about that in a moment, maybe. And then your gain so far, it's an unrealized gain because I haven't been paid out on it per se. It's there, but I haven't actually said, hey, give me my money. And then the value of what it's worth right now. So you can see up here I have a variety of different stocks. I have AbbVie, Visa, which is the company that issues Visa cards. A financial group. This is a financial, more like a bank or a lender. Johnson & Johnson. Johnson & Johnson has been around a long time, a great dividend stock. This Broadcom stock has actually done really well over the last year or two. A communications company. JP Morgan, another financial services. Personally, I think the financial services company this year are poised to have a good year, assuming that COVID gets under control and that things get back to more normal with financial, with people and working and so on. AT&T, this is one that I'm not really sure about in the long term. So I'm a little bit on the fence with them, but they have a pretty good dividend yield. Realty company, income. This is like a REIT, a realty investment trust. Bank of America, GPC, Kimberly-Clark Corporation, Iron Mountain, Newmont Corporation, Lockheed, defense contractor, Cisco networking company. It's been a great company for many years now. Enterprise products, Microsoft, Altria, Home Depot, and Apple. And I did some research on all these companies. Confess I'm not by any means an expert on all of them, or even most of them, I would say. But looking at their dividend yield and looking at what they're likely to do over the next year, I thought they were worth the risk to start this portfolio with. So you can see here that right now I'm up about $13.72, which is a 0.68% gain, basically 2/3 of a point, which is not bad. I mean, I've only had this portfolio for basically a week. So I don't really, have a lot of history with it. I don't really have much money in cash. I just deposited another $500, which will be going in. And I'm trying to decide if I want to, my biggest challenge right now is to decide if I want to sell all these positions and recreate all this in the Roth IRA. I do have a Roth IRA already set up here, but I haven't funded it, and I would have to sell all these, which will generate some losses, some gains, and then recreate everything over in the Roth. I don't know. I kind of screwed up. That's where I was saying, like, if you're going to do a Roth in this, and you probably should, a lot of people should, then do that at the very beginning. I don't know why I set it up like this. I just wasn't thinking straight. Actually, what kind of got me is this auto invest button was on. And what that means is that the second money hits your brokerage account, it starts divvying it up based on the percentages you had set up. So kind of be cautious of that. Like if you create a portfolio, you could turn off the auto invest. You can also set it up for certain amounts. But the amounts will tell you like, all right, if it's below this amount, don't auto invest. Like if you put in here minimum cash balance, $1,000, which is probably not a bad idea. That means as long as it doesn't see anything hitting your account for $1,000 or more, it won't auto invest. Or you can just turn off auto investing, period, and just be doubly safe. So that was probably not the greatest explanation, but I did the best I could. So I think that particular portfolio has potential to build and build and build. I was going to kind of show you what the potential is. I'm going to go over here to a different screen. I like Google Sheets to keep track of things, and I found this great dividend and portfolio tracker from a guy named Adam Venture. And if anybody wants a copy, that would be just hit me up in the message. I'll try to put a link to it in here just to share a copy, and you can create your own. It's a Google Sheets, free. You can just create your own. But a guy named Adam Venture created this, and so let me see if I can get this to come up here. Oh, let's not do that one. Let's do this one. Actually, we could probably just do, yeah. So this is a dividend portfolio tracker. And I've started tracking all the dividends I have. I have some other things over here in Robinhood with this portfolio, everything, but I'm keeping all my investments kind of here in one place. All these companies provide you financial statements, but sometimes it's kind of complicated to figure out exactly what's going on with it all. Honestly, it's a little more complex when you have dividends, for sure. So I've started using this spreadsheet from this guy named Adam Venture, and I went in and put in my own numbers in it. You can see up here I have some Bitcoin in this Robinhood account, but let's focus on just the dividends for a moment. And I think, oops, I didn't mean to go all the way down like that. Let's just turn on a filter real quick, and we will only look at the M1. All right, so there is just the M1, which includes all the dividend stocks. Now, what's cool about this portfolio, this spreadsheet, is it has the ability to, by using this Google Finance formula you see right here, it has the ability to pull in the current price of the stocks that you own. So once you have like the total shares you have in here, which was over in that M1 page, you can put in, all right, I bought this many shares. And then you use this little formula that's in the spreadsheet, and it pulls in the current share price of whatever's over here in this cell, which in this case is Visa. So it knows that, all right, Visa is $218.73 a share. You got this many shares. It shows you the day change, the total day change. And then it shows you your average cost basis. You would put this in. This is all kept for you over that M1 finance screen. Your total cost basis, it will automatically figure that, and then it'll tell you how much you have in that stock automatically. Like, this is all just formulas. You really don't have to put anything except your average cost basis and the total number of shares you have. So you could like update this once a month, once a quarter, whatever works for you. There's probably ways to pull in some of this automatically, but it's a little bit more complex than you think, especially when you get dividends and you're getting them reinvested, because they get reinvested, then they buy more shares. So then you have more shares than you had before. So you have to kind of go back in and put this one back in. And then over here, so I went to Yahoo and I looked at each of these symbols, and they all have what's called an expected dividend for next year. And basically, the expected dividend is how much the estimate is that these companies will pay per share. So like for Visa, the expected dividend for 2021 is they will pay $1.28 per share. All right. So that means for every share of Visa you have next year, assuming that that's the dividend that's going to happen, which it probably will, could even be more than that, you will get $1.28 in income. O has 281, JP Morgan 360. This company, LMT, this is Lockheed, has a $10.40 dividend, but they have kind of a more expensive dividend or share price. So I don't have anywhere near a whole share yet. I've got like 0.28 a share. So, and this column over here figures out the yield, which is just a division of, this particular one divided by the actual price, and just tells you how much the yield is. And so you can see there's different yield percentages over here. I'm going to try to make this a little bigger for you guys. Let's see if this will, because I realize it's probably a little bit harder to see, right? All right, so maybe that's a little better. So you can see over here, like there's a yield percentage. And let me scroll over. That yield percentage, you would think you would just want the ones, again, with the biggest yield, but that's not necessarily true because sometimes those companies might not be that great, doing that well as companies. So that's something to keep in mind, like looking at this yield. And usually what you want to shoot for, from what I understand, is somewhere around a 3 to 4% yield per year. You can see right now, I think my current yield, actually, I don't have it configured. I need to figure that out. But I think it's going to be over 3, if I remember right, for my M1 finance. And I guess I could just put it right here, couldn't I? So, oh, that's not going to work. Let's see what we got here. Okay, that's not going to work. All right, so I've got to figure that. But the yield percentage is going to be in this column, and the last column over here is the estimated annual income. And so this is how much income, based on the number of shares I have, based on what the yearly dividend is expected to be, that if nothing changes for next year and that yearly dividend is correct, I would earn this actual amount of dollars, which you can see here is $82.72. Now, I know some of you are going to probably say, well, that's not very much money. You're right. It's not a lot of money. But let's remember something. That $82.72, if that's all it ends up being, first of all, I'm going to be buying more of these companies throughout the year. So that actually will go up because I'll start earning more shares over here. But that $82.72 is free money that you did nothing to earn. And if you think about, like, that money gets reinvested back into these companies. So you're buying another $82.72 of these particular companies. Plus the companies are hopefully earning, a percent return as well. Like they're going up in value. So you have more equity and wealth there too. The idea here is that if you were earning, say, 3% on your portfolio and you had a $100,000 portfolio, let's say, of equities, you would be getting about $3,000 a year in actual dividend income. That is income that you literally could take out of your M1 finance or whatever broker you're using, and you would still own just as much stock as you did the year before. So as that builds, you're building another revenue stream that down the road, if, I'm looking at like 10, 15 years from now, that maybe I can build this portfolio up to 100, 200, 300, $400,000, whatever, as much as I can pump into it. And it's just going to produce income every quarter, actually, for the most part, and every year. And that income, I'll never even have to touch the principal of the underlying securities if I don't want to. That income will just come, and it's just money that I'll have back. It's just like you're earning a return on your investment, but you're also just earning this extra income that you're just going to get. And, theoretically, you'll get this forever as long as you own the securities. So as long as they keep paying a dividend, which that's why you pick the ones that tend to have like this long track record of dividend growth and paying dividends. So I hope that kind of makes sense. I know it's there's a lot of terms and so on there. So I'll definitely, if people have questions in the comments or so on, I'll answer them if I can. I know there's a couple of questions already missed where Rebecca said, can you do a video on how to research a company? Yeah, that's a good idea. I can show you what I did, Rebecca. I am by no means any kind of expert on this. But I think that I will be able to maybe explain kind of the logic that I've learned and see if it makes sense to you. And then, you can obviously, you want to do your own research as well. Don't you pay double tax on your profit and when you pull out your money? Not necessarily. So here's what I understand about it, Sam. That's a good question. And someone correct me if you're wrong. What I've learned is that below a certain threshold of income, your dividends aren't even taxed, even if they're not in a non-retirement income account. I believe for a single payer, it's like 39,000 something in gross income. And then for a dual income household, it's like 80. Not everybody's going to be under that amount. Some of you might be above that amount. But always check with your tax professionals and so on anyway. But if it's in an IRA account, a retirement account, my understanding is it's going to grow tax-free anyway until you theoretically pull it out. That's different. But like if it's in a Roth and you're investing, $6,000 a year in it, let's say, which is the max, unless you're doing catch-up contributions, that is going to grow tax-free. That's the point of a Roth. So good question. What's up, Eric? That's my friend. I have not seen him on this channel in a while. I hope that the VCR, Vanguard Consumer Directory Discretionary Index, will do well as the economy starts to recover and people get back to buying stuff. Yeah, I mean, Vanguard has a great lineup of funds and indexes, ETFs, and so on, all kinds of things. So they're a very good. I'm gonna take this back out of full screen. They are very good choice for you guys if you're looking for somewhere to invest. They have very low fees, and I think the index he's talking about is probably based in companies that I would guess are. I'm not sure all the weight and the types of companies that are in that index, but I'm guessing they're ones that have to do with as people consume things and buy things. So if people are working, if they have opportunity, if businesses are open back up, theoretically, a lot of those companies should do pretty well. Charles says he likes me better when I sold jeans. Well, what can I say, Charles? Life, we all evolve. Ninja says a high dividend is usually a red flag. Yeah, I think you're right about that, Ninja. A lot of people get enamored with just the actual dividend amount it's paying, but you really have to look at the yield percentage too. And then you have to look at the company's history and look at the company's ability to continue. Like, are they going to be able to continue that dividend? Are they going to be able to grow it? Because when they grow it, there's like a compound effect. I'm going to see if I can find this. The website I found that shows you on stock returns, dividends. I wish I had that paper still up, but I don't. So there's some good research out there that shows that dividends drive a good chunk of the stock returns of a lot of different companies. But that's assuming that the companies we're talking about can afford to pay the dividend. So I don't know if I still have that chart. I was going to try to show it to you guys. No, this might be it. No, that's not the one. I don't know what that is. So I don't have that study right in front of me. Let's see if this is it. Yeah, this particular chart, I'm going to see if I can pull this one up for you guys. This was on Seeking Alpha. Let's see. Seeking Alpha is a pretty good website about that has all kinds of investing advice. I'll see if I can share this page with you guys. And this particular, dang, all these stupid pop-ups are driving me crazy. All right. So let's see. Let's do this one. Yeah. So this chart right here shows you the cumulative return of dividend payers versus non-dividend payers. The non-dividend paying stocks, this was over like 80, 90 years, long time. But the dividend paying stocks actually did better than in this particular case of a hypothetical $1 invested. It went up to, about, if you'd invest in $1 in the stock market in 1927, and didn't put any more in, you'd have about, I don't know what that is, $4,700 versus just in the non-dividend paying stocks, you would only have about $1,300. But then they have this logarithmic one down here. I'm not exactly what the differences are here, but the returns get closer. But you can see with these two charts, the dividend paying stocks tend to do better. The tricky part is getting kind of the right ones, just like anything else, right? It's like not every dividend stock's great. Not every growth stock is great. So you have to find ways to kind of help figure that out. But there's all kinds of research out there that shows that I'm going to go off of this. There's all kinds of research out there that shows that dividend paying stocks often are better run companies, which you would think in the long run would do better than non-better ran companies, right? That doesn't mean every growth company is ran poorly. A lot of them are ran really, really well. But a lot of here's what happens with a lot of companies I've learned. A lot of their growth is early on in their evolution of as a company. In that first 20 or 30 years, if they end up being big companies. Because here's what happens. Like, you guys know this in your own, we've talked about this in reselling and other things. It's easy when like you've got $500,000 in sales and you need to go and you grow your sales to $1 million, like you as a company, like you double your sales. That is not a huge, depending on what you're selling and the way it scales, that's not necessarily that difficult to do. When you have $500 million in sales and you have to scale to $1 billion in sales, that is much tougher. And when you have 10 billion, you want to scale to 20 billion, even harder, because there's like those, you have some economies that scale to a point, but your growth rates tend to slow down as companies get larger. It's very unusual to see big companies that can grow 10, 15, 20% a year, grow their revenues that much, because there's just not that much business out there to be had. Plus, it gets more and more complex and expensive and tricky to run those larger corporations too. They don't maneuver as well. They're not nimble. They can't make decisions on a turn, on a moment's notice. So I think that like that comes into play with growth stocks versus dividend stocks. A lot of the dividend stocks tend to be older, more established companies. Not all, but a lot of them. And because they have that financial requirement to pay out dividends, or at least that's what their shareholders have come to expect, they have to run differently than just a pure growth stock that's not governed by that can just kind of do whatever it wants. And, people will figure it out, and if it's a good company or not, but they're not as worried about having to pay a dividend. Like, they can take all the money that they're getting from sales, getting from their, their whatever it is they're selling, their product or service, and put it back into the company. Whereas a dividend paying company cannot do that. So it changes the way you got to run it. It's kind of like when you run the business of your home, like you're paying out the dividends of your salary to all your creditors. Like that the rent or the mortgage company is going to expect that payment every month. So you can't just spend that $1,000 or $2,000 or whatever it is on something else. Like, you have to have that put aside or there's dire consequences, right? So you have to kind of run your household the same way a lot of dividend paying companies do. You can't just absorb all the money in and not worry about your shareholders as much. Not to say that growth companies don't worry about shareholders at all. I'm not suggesting that. I'm just saying, but it does change the way you run your business. So that was a long explanation. Let's see. There was something else I missed up here earlier. Somebody was talking about AT&T, and now I don't see it. Didn't somebody have Clearance Ninja? Yeah, so AT&T, which is T, that's the symbol for it. The dividend is safe, and they're paying down debt. Do you work for AT&T, Ninja? You say we. It hasn't been a growth stock since I started. Oh, okay, cool. But it's paid its bills. Yeah, I actually worked with AT&T for a period of time as well. Yeah, I think their dividend is maybe safe, but I'm just worried about their debt. AT&T has incurred a lot of debt, and they're betting a lot on their HBO packages and so on, and becoming more of a streaming service company. And not that they can't do it, they certainly have resources, but some of the other big players like Apple and Disney and Netflix and Amazon are ahead of them. in a lot of ways, and it's just a tough market to break into. But it's also probably a big market that's continually growing. There's no doubt that streaming services are growing very quickly. People are shedding off cable subscriptions and things like that, and just having streaming services because there's so much variety out there. So I hope they do well because, like I said, I own them. One thing about all this, guys, is really cool. Like when you buy, for those of you who don't own any stocks that own, like you're investing in that company's success. Like you have a piece of it when you buy that. And that's kind of cool to do, to think like, these decisions that are getting made. It will make you much more in tune with what's going on with a lot of these companies when you start investing in them, which is kind of cool. I think it's kind of cool. But anyway, let's see. The markets will do great as long as the Federal Reserve keeps it all afloat. Yeah, they've put an awful lot of money into this economy. What's up, Landshark Picker? VTSAX is great. Total stock market. Yeah, I don't know a lot about that particular fund, but I will definitely try to look it up a little bit and see what I can find. When the market crashes, it will be epic. Yeah, and this brings up a whole other question, and maybe it's not really related exactly to dividends, but where is the scared money going right now? I've heard this theory that people are starting to look at Bitcoin as more of a hedge against the market crashing. So they're starting to hedge some of their resources over there. I don't know if that's true or not, but Bitcoin has certainly seen quite the run up lately. I've actually sold. I had a very, very tiny position, but I've actually sold it with like 100% return. And I'm like, I can't deal with this. It was making me nervous. I'm like, oh my gosh, this is ridiculous. I'm not one of those people who thinks it'll go up forever, like anything. Like I know that's not true. And we probably are going to have a correction here sometime. Once the stimulus dies down and, even once the economy comes back, it's going to be rough, for a bit. So, but I did see the unemployment numbers were better today than they thought, which was good. Moonshineful says gold, silver, and Bitcoin. That's where it's going. Yeah. And, Moonshine Fuel, you make a good point that even with this dividend portfolio or any portfolio you guys do, like it's not a bad idea sometimes to have a percentage of it as a hedge. And basically a hedge just means that you're investing in one set of securities or funds or minerals or what have you, crypto, whatever, in the idea that if the other more traditional investments you have go down, then theoretically the hedge won't. So you'll not take quite as much of a hit return wise. I don't know if that's accurate or not, though. I don't know, because I've also heard that Bitcoin has moved roughly in step with the market. So, but gold has been a hedge that people have used for decades. Like they'll invest some percentage of their portfolio in gold or silver, just in case like the stock market goes down. They can be like, all right, well, I've got this 10% over here that actually went up because people started fleeing stocks to went into it. So that offsets some of my losses in other areas. But that's a whole nother topic that I don't think I'm really very capable of talking about. But all right. Well, thanks guys for listening tonight and stopping by. Hopefully that explained the dividend portfolio a little bit. If you have any questions, feel free to reach out or leave one in the comments, and I'll definitely do my best to answer it. I'm definitely not an expert, but I've learned just enough to be dangerous, maybe. So if I don't know, I'll just say I don't know. But I appreciate you guys coming out tonight. Check out the description after this video post. I'll have a link to M1 Finance if you want to check it out. It's really cool. There's not really a cost to sign up, so it's really cool, I think, as a way to invest. And dividends are definitely a potential useful tool in your portfolio, or having a portfolio, I think, can provide you some decent returns. So, the link to the spreadsheet. Oh, wow. Yeah, that's a good, let's see. Can I just copy this right here? I think I can. Hold on. I can put that in here. Well, yeah, I need to see. All right, I'm gonna have to figure out how to do that. I don't remember exactly where I got it from. I'll have to look at the web page and get it and post that in the comments, Rebecca. So look for that in the comments. All right, guys, that's going to do it for tonight, though. Thanks for tuning in, and let me know what you thought, and I'll see you guys later.